Stupid law of Mike. Today, we are going to have a fireside chat with the mentors from the startup. And what this chat is going to be about, or hopefully what you will learn from it, is information on Venture 101. The most common thing that I hear from student entrepreneurs is, oh, I need to raise money, or can you introduce me to a venture capitalist? Or they throw out numbers like, yeah, I'm looking to raise like, $1 million in an A round, and I'm not really sure 99% of the time that they really know what an A round is. So we are going to probe and prod these gentlemen today and see how much information they will give up on everything from what they look for, what they don't look for, and maybe share some of their own war stories along the way, and also find out how they ended up becoming venture capitalists, because that in and of itself is a really interesting career path. So without further ado, let's welcome back Evan. Adrian. And Jake. Clearly blue was the color-coordinated color of the day today. Gentlemen, first question. Some of you work in early stage, some of you work in private equity. Evan, maybe you'd like to start out by explaining what someone who works in private equity actually does.
So somebody that works in private equity invests in companies typically that have obviously hit commercialization and have some level of profitability, which can go all the way from kind of lower middle market, which a lot of people describe in different ways, but often $3 to $10 million of EBITDA, which is a proxy for cash flow, all the way up to very, very large companies, or taking large public companies back private, often using leverage. So you hear the term LBO, or leveraged buyout. Private equity is typically small to large leveraged buyouts. There's firms that raise huge funds of money from wealthy individuals, from a lot of different type of institutional dollars, pension funds, and then deploy that into many, many companies, hopefully getting to a point where you're paying back those people that are investing in the funds with their principal back, as well as a return on that principal.
So what's one of the most exciting or most miserable deals you've worked on to date in your career?
Let's talk about a good one. Probably the most interesting and best deal that I've ever worked on is a software company actually in Alabama, of all places. I know it's a hotbed for technology. So Birmingham, Alabama, there's a software company that works in ready-mix concrete, of all things, and has about a 85% market share in the US and 60% internationally. And our firm invested in 2005. They are still investors now, and they have returned several times the original investors' dollars by doing what's called a dividend recap. So you re-leverage the balance sheet and take out a bunch of capital, repay the investors, and still have ownership in the company. So they've done several dividend recaps over time and still have a large ownership stake. The management team has done extremely well, and really cool working relationship between the management team and the investors, which is usually the case, but not always the case.
And just so I'm clear, do the deals come to find you, or do you actively go out and find the deals?
I've never worked at a place where the deals come to find you, at least not the good ones. This job is all about hitting the pavement and meeting with, a current job meeting with entrepreneurs, that job meeting with mature companies, sometimes through bankers, but more often through relationships, through knowing a lot of people, through having proprietary deal flow. That's where you're getting the kind of interesting, hopefully slightly less competitive deal opportunities.
Okay, Jake and Adrian, what does a venture capitalist actually do, and how did you both get to become or call yourself one?
Well, venture capitalists invest in mostly technology companies, traditionally things that you can put a little bit of money into and make it create. It's a lot of risk, and you're going to theoretically, some of these companies might be worth 10, 20, 50 times what they were worth when you invested in them to start with. So that's kind of the origins of venture capital in Silicon Valley. Our investing in really risky technology companies that have a lot of upside. It's a little different than, you know, a more mature company where you can see they're at $10 million in cash flow, and maybe we can take them to 20 or 30 and sell it for 3 or 4 times our money, and that would be a great deal. And so, so where we work at in venture capital is on the earliest side, so we call it seed or Series A, or there's a lot of jargon out there, but
well, hang on. Take a second to talk about that. So what, for example, is the difference between an angel round and a seed round?
The real difference is mostly marketing. I'll just say that. Like, I think there's the terms, when I started making investments when I was at the Wolverine Venture Fund here at Michigan, what we called an A has now become a seed. What we called a seed has now become an angel or a friends and family. Or and yeah. if you're an investor, most investors want to be in early, right? That's the idea, right? Like, I don't want to be late, I want to be early, right? So there's some marketing to how you describe the way you're fundraising. And so people have kind of pushed the terminology up so that, okay, we still haven't raised our A round yet because we were just doing that was our seed, and that was our friends and family, that was our pre-seed, that was our double A, you know, so all the things you can raise until before, and then the A. So even if you're the 4th investor in the deal, you're in the A round, and you still feel like you're early. So there's some marketing associated with that. But all that aside, a typical Silicon Valley Series A nowadays is like a $5 to $10 million round where you're selling 20 to 30% of the company. But most deals are not done in that typical fashion. But that's kind of, I would say, the standard Series A. And they're talking about the size of the check and the stage of the business. And maybe a seed round, you would say, is like a $1 million to a $3 million round. And maybe if you're in Detroit, it's a $500,000 round. And so the terms, it's really kind of, it's a lot of jargon, but they mean different things in different markets.
So generally speaking, you guys are not spending your own money on these highly speculative investments. Adrian, can you talk a little bit about how a fund is raised, what a limited partner is, yeah. What it means to close a fund, et cetera?
Yeah, so I would add on to what Jake said, you know, the difference, and I think you're hinting at that, Tom, like usually an angel fund or an angel group, it's their own money, kind of they are investing their own personal wealth into a company either through a fund or directly. And so there's a difference in maturity most times. That's kind of the market indication. If you have angel money in, it kind of means there's not an institutional fund that's come aboard, kind of put you on that kind of, you're probably still an LLC, and a lot of times at the angel stage, you've not become the proper corporation that, you know, most venture capitalists need you and institutional investors need you to be. In terms of what an LP stands for a limited partner. They are our bosses in they are who venture capitalists answer to. So not so much bosses. And the way that a startup company who's taken venture capital money has to—
Because you guys are all badasses, yeah, and you don't have bosses.
We don't need a boss. Yeah, should tell my boss that. So at the end of the day, we take money from LPs, limited partners, who we have to report back to on a regular basis of how our fund's doing, how we've invested their capital, and what kind of we project the future to be based on where we sit today.
How do you guys decide how much money to raise yourselves in a fund?
I'll just add to that real quick, which is, so I was just in a conference yesterday where rather than entrepreneurs and VCs on the stage, it was VCs and LPs on the stage. And so it's like, that's the analogy, right? The limited partners tend to work for big institutional funds like the University of North Carolina Endowment. And that guy will be sitting right here and he'll say, here's what I look for from a venture fund that I want to invest in. I want somebody who's got their own proprietary deal flow and they're getting deals, you know, and they've got a great brand, and, you know, they could be a seed fund or they could be a later stage fund. And so there's a lot of jargon, but really it's just the venture capitalists are out raising money the same way startups are out raising money. Yep. And so that's what the conference I was at yesterday was.
How do you decide like how much to raise when you say we're going for our next fund?
It's kind of the same way the startup decides. They raise as much as they can. They basically say, depending on who they're talking to, they say, you know, if they think they can get away with it, they'll say, I'm raising even more than what they need. No, I would say you think about, the more logical way to think about it is, what's your investment strategy? Are you investing in really early stage deals that are like $100,000 a piece and you can't do a million $100,000 investments? There's only so many investments you can do. So if you're writing bigger checks, you could raise a bigger fund. If you're writing smaller checks, you could raise a smaller fund. That's kind of a general rule. And then you think about how many deals you can do, how many partners you have, what's your capacity to sit on how many boards. You kind of put all that into perspective, and then you come up with a number. For us, our first fund was $55 million. We deployed that over about 4 years. We're towards the end of that fund, looking at our next fund. We just invested in a fund that has a target of 40 million. They just did their first close at 25, and they'll do 50 investments out of that fund, and they'll start in the $250,000 range, going up to $1 million. Detroit Venture Partners, we were doing, maybe starting at $500,000 up to $3 million. Maybe we'll have 20 companies in our portfolio. So you start to do the math and figure out how much money's in there, and then you take your management fee out of there too. So the bigger the fund, the more you get to spend on yachts.
Talk a little bit about your management fee.
About my personal management fee.
You could say you have a friend, or hypothetically.
That's how venture investors pay their bills. I mean, you can't take everything on the upside. Meaning, you get paid if you make a good investment and in 10 years the company sells for $1 billion. You're going to get some money out of that, and they call that the carried interest. You get a percentage of what you make for your investors, but also you need to pay your bills along the way, and so most of the time you're taking a management fee, which is a percentage of all the money you have under management, and that can range from 1% to 3% depending on the structure of the fund, but 2.5% is.
Has the competitive landscape changed for you guys in the last few years in terms of acquiring LPs?
I have a unique situation, and every fund is unique.
Yeah.
So our fund, so Dan Gilbert, who's in Detroit, who I worked for the last 5 years, is the biggest investor in our fund. He's half of our first fund. He's half of 2 other funds that we've started. And so when you have a big anchor limited partner, it's a unique situation. Most of the time, that's not the case. Most of the time, if you're raising $100 million, you've probably got a $15 million anchor LP, and you're out there getting $5 million here and $3 million there. So we haven't done a lot of fundraising is the bottom line.
There's also a progression of kind of track record too, right? So our first fund was more of what's called a pledge fund, which is, and this is years ago now, but you go out and you find opportunities and then you pass the hat and you say, do you want to invest in this particular company? Do you want to invest in this particular company? And there's fees and whatnot associated with those particular investments. You do well in something like that and you're able to raise a more institutional fund. So our second fund was 25-ish million. You deploy that and you build your track record, and as you build your track record, you can raise more capital, you can bring on more people, and so the fundraising environment has changed for us only in that we have a longer track record, more companies, more returns, more things to judge based on than going out and, the challenge of fundraising for a new fund is the same as for a new startup. You haven't proven a whole lot yet when you're going out to raise, and so
it's even harder.
It may be even harder. Track record is everything. So I think it gets easier the longer that you build your track record, and oftentimes your fund gets bigger over time. You also have to, though, determine what's your real strategy and make sure that your fund size doesn't get totally out of whack with what you're actually good at doing, what types of deals you're actually.
And I was just going to add to that, certain funds will have different, LPs invest in funds for different reasons. So, as Jake has an anchored LP, our first up fund, which is now 5 years in, we've deployed most of that capital. It was a small $5 million fund, which I know $5 million sounds like a lot, but it's tiny when you kind of come into this world. And that one LP wanted to make sure that we were deploying capital, not solely to specific groups, but with an attention to specific groups. So we were told, look, deploy this however you want, however it sees best, but we want you to pay attention to minorities, to women, to LGBT folk, and companies in Detroit. Pay attention to them. So if it means spending more than 5 meetings with them to get that check in, do it, because that's your mandate. Now, the vast majority of our fund is not that, just because of the way demographics work out, but it is, I would say we're probably heavily weighted in those categories, more so than a lot of funds, because that LP gave us that mandate. And because we performed on that mandate, we're able to go back, fundraise from them for our next fund, which is called Detroit Innovate, which is double the size, but still small. But we consciously, part of that's fundraising. It's hard to fundraise right now, but part of that is, not hard to fundraise, but part of that is we have this geographic focus So raising a massive fund for us it's really hard to project those returns based on what's going on here.
Right, you don't know how many deals are going to be in this market.
Completely.
Right, it's kind of a new thing. There's not a lot of venture funds based in Michigan for however many years that have returns of X amount.
And you always want to under-promise and over-deliver. So we'd rather take $10 million and bring back 50 to the table than take 10 or take 50 for us, with our focus, and then be like, we kind of got 52. I don't know, right? So for us.
Well, so I read the beautifully put together Michigan Venture Capital Association annual report, and we pay our membership fees. Are you guys bullish on venture capital in Michigan? Have your thoughts changed in the last couple of years? You talked about the environment for raising money.
Mm-hmm. So
what's the truth?
Yeah, I mean, look, 2016 is going to be an interesting year. I think everyone nationally would say that. We don't know. We kind of saw a little bit, slowdown may not be the right word, but there are a lot of unicorns out there. So these companies that are worth $1 billion or more. And someone way smarter than me in this space, would
all the unicorns in the audience please raise your hand?
Right? No. I wish I was worth $1 billion. So someone way smarter than me in venture, kind of one of the guys who founded Kleiner Perkins, which is this big kind of venture fund, storied venture fund in the world. At a conference a few weeks ago, he said his prediction in 2016 is 90% of those unicorns would have a down round, which means they would be valued at less than what they're valued at today, or they would be gone by the end of this year, right? And that's a massive kind of dramatic prediction, but that's kind of the winds we're kind of up against right now. So how does that play out in Michigan? Well, Michigan's not Silicon Valley, so it's going to be a little bit tougher here. That said, we hope prices will be more in line with where we think value is, which means we are going to get, as investors, a better deal. I think the past few years have been very entrepreneur-friendly, which means they've been able to raise prices up, and then it's like, we can't participate, it's too expensive. And now we're already seeing round sizes decrease, values decrease, which isn't a bad thing for your company at all. But at the end of the day, it's a better deal for investors.
But let's talk about pricing deals for a second, because student entrepreneurs in particular, they focus very early on equity, and they want to, they're giving out equity to their friends or their co-founders, and it's equity of nothing, frankly. Yeah. But they end up getting in fights and founder disputes. And can you talk a little bit? I mean, you threw out the number of 20 to 30% in an A round, but how are deals priced, and what are some reasonable expectations in success for an entrepreneur who makes it to the first of those 5 meetings with you?
So I'll start chronologically and then pass it off to one of these guys. When we're investing, because we're investing super early, usually the first kind of round of money, we're not putting a price on your company. We almost want you to do a convertible note because it's too early to try to put a price on your money.
Stop, you have to tell them what a convertible note is.
So convertible note is effectively a loan that if it's successful, if your company gets that next round of financing, it will convert at that time at the price that investor determines your company to be worth. So we get rewarded for going in early by being able to convert at a later price. We get to push off this question of pricing because we think it's a little hard to price your companies super early. There's really no market to price it on. And then we get a discount on that. If they're buying at $1 a share, we'll buy at 80 cents a share, something like that, at a very simplistic level. So if you come to us and you've given away 50% of your company to your friends, and you're not even at a convertible note round, something is not right. That just isn't a good position to be in. We recommend pushing off that valuation question for as long as you can in your company, which means keep your equity tight. Keep 100% of that equity for as long as you can. Because the minute Jake comes in, he's going to want 20 to 30%. And that's
well,
totally
let's let
fair.
Jake tell us about that.
Well, I also would just take a step back to say that, because I was here in 2002, I started a company in Ann Arbor. I started undergrad in 2000, so I graduated in 2004, worked on that for 4 years, never raised any venture capital. Most companies never raise venture capital. Venture capital is a weird thing for a small segment of a small group of companies, and most likely if you build a really successful company and make a lot of money in your lifetime, you won't have raised venture capital. So like just that's like setting the grounds. Because I think in general now, if I read it right on campus, there's this general idea that like raising money is like an exciting and great thing to do, and it is for the right companies in some ways, but it's more of a necessary evil than anything else, right? I mean, you have to go out and sell chunkier company. I probably looked at it the most extreme way when I was an undergrad. I said, why would I sell any of my company? We were winning these business plan competitions and people were asking us to invest, and we're like, no, we'll keep it all. Thank you so much. And that's silly also, because you'd probably want to understand that if you raise money, you can invest ahead of your profitability and actually build an even bigger business faster. And so there's reasons to raise money, but in general, so this is just the caveat, in general, most companies are not set out for venture capital, and the best thing you can do as an entrepreneur is build a product someone wants to buy, go sell it, use that money to build your business. And so that was the caveat. Then the question is, for venture capital, what do we look for? Yeah, 20% is a decent number. The last deal we did, founders were real experienced entrepreneurs. He had been a CEO before. They took $1 million of their own money, invested in the company, built up the company. By the time it came to us, the company was priced around, it was a higher price than would be a typical kind of first check in a company because they built it up. We invested $3.5 million. The round was about a $3.5 million round, and they sold about 20% of the company for that price. So the general idea is if you're selling 50 to 60%, something's wrong. If you're selling 2 or 3%, something's wrong.
So it's not like Shark Tank where they say like, I'm here to get $500,000 and I'll give you 5 cents of my company.
No.
Similar.
Yeah.
Well, now, Evan, you deal with a lot more empirical data in your deals.
Yeah, so one stage later, we're typically in again, there's a lot of these acronyms and stuff, but what would probably be a Series B or a Series C, which is one stage, maybe 2 stages later than when Jake's firm comes in. So these companies have revenue, typically several $1 million of revenue. There is a business model. There is kind of gross margins and EBITDA or negative EBITDA. There are things to actually kind of tangible things where you can say in an industry like this, something might trade at this kind of revenue multiple or cash flow multiple. And so we do kind of use market-driven multiples, but I will say it's even at the stage that we're at, which is not private equity, it's kind of late venture. Even at the stage that we're at, it's really more art than it is science, because you need to get to a place where everybody's comfortable. You need to get to a place where once the deal closes and you're on the same side of the table, everybody's friends, everybody's going towards the same goal, which is enterprise value creation and shared value creation. So you got to get to a place where people feel comfortable, and then you can solve a lot of the noise around valuation with terms. You can solve it with governance. You can solve it with a lot of different things that go into these structure-heavy term sheets. That's not just a number. So in other words, if somebody wants to get to a $20 million pre because they want to tell their friends or they want an article about it or whatever, there's ways of getting to certain numbers and still having the investor feel like they have been given a fair shake, and you can solve a lot of things with things that may not be kind of headline material, right? There's a lot more to the story than somebody has just got $1 billion pre-money valuation. Yeah. There's a lot going on below the surface there.
So let's talk a little bit about our student entrepreneurs and some of our favorite subjects, like who would like to share their favorite pitch story, good or bad?
I just went through one about a month ago. And it's not a favorite, but it's kind of a story I share. So I had been meeting with this entrepreneur. It was probably my second meeting with this entrepreneur in particular. And it was kind of getting to a point where I had given some advice, some feedback in the first session, said, if you can address these things in the next one, let's keep talking. And it was clear that they had not addressed that. And so you have to make a decision very early when people start talking to you. And I would say broadly, this is not just venture capitalists and entrepreneurs, of whether to waste this person's time and let them continue talking, or just go straight to the heart of things and be like, okay, where's this, where's this, where's this? And so I decided to take that approach, which by the end of it ended up being really, really productive. And that entrepreneur is now in a accelerator type program and kind of getting the help that person needs to kind of build the business. But about halfway through it, just tears pouring down this entrepreneur's face. I'm freaking out because I'm like, oh my God, I've never made someone cry.
Well, you were really mean that day.
I was just.
He's pretty mean
generally. I'm not mean
Yeah.
at all. I'm really nice.
Weren't you the CrossFit guy in that mentor video? Yeah, you're badass.
And I teach yoga. I'm not mean. No, but it's kind of like, it's a question of like, my time is valuable. Don't waste it. And be very honest with me whenever we do anything. And so anyway,
Wait, let's probe that for a second, and I'd like to get sort of a round of answers on this. You know, the whole honesty and transparency thing when talking to venture capitalists. Most people like to put their best foot forward, and arguably at a startup, you're very uncertain about many things. What's the right level of optimism versus brutal, blunt honesty from the entrepreneur's perspective?
Meaning, how honest should the entrepreneur be with the investor?
So the best piece of advice I ever got was my analyst training day, kind of coming out of college, was if you do not know, say I do not know. That is okay. You can say I don't know, but I will address it, or I don't know and I can get back to you. That is, look, we're investing at the earliest stages. There's so much unknown. We're okay with it. But if you come in, usually my red flag is we have no competition. We're super unique, blah, blah. It's like, okay, you didn't do your homework. You obviously have competition. You obviously, even if you are introducing something really unique, there's adjacent markets that someone's already doing something interesting. So it tells me you are not actually doing your homework. And so those are the things I don't like puffery. And if you're gonna be super honest, I respect that, but that is my personality. So it's really important to do your homework with VCs before you meet them, because some people will be okay with the puffery. Some people will just stop a meeting because
All right, the other two guys are nodding. Would you like to comment on this?
I think it's the same thing as if you're going for a job interview. Has anybody, you guys have interned places, so you've probably done some job interviews. You don't want to like say you don't know the basic stuff. Like, I'll just be honest, I don't even know what you guys do for a living. Like, that would probably be a bad thing when you walk into a job interview. But it's okay to say you don't know stuff that you probably shouldn't need to know and not fake it, because if you get caught up in a lie, then, you know, I had like 6 or 7 different versions of my resume, and I would put my best foot forward depending on who I was interviewing for. And it's a similar thing for, you want to put your best foot forward, but you don't want to get caught up in a lie. And it's so easy to kind of like get caught up in like some, you know, it's just very easy with investors to kind of, they'll see through it when you're faking it. So yeah, I like that, but it's similar to a job interview, I'd say. You put your best foot forward, but you don't lie about your background or about what you know.
Yeah, I also think it's hard. I mean, it's a little nuanced, right? There's a very fine line between being honest and saying you don't know occasionally, because we all have very high BS meters when somebody comes in and says they have everything figured out, because even at very large companies, there's problems. We all know that. So if you walk in the room and you come at it with that, you say, okay, that's unreasonable. But you also need somebody that's confident, that knows their business, that is right on it, and so it's a very hard thing. It is like a job interview. You don't want to come off as overconfident,
right,
and you also don't want to come off as ignorant. And that's, if you hit that line, you can get through to somebody really quickly. But either side of it's pretty tough.
What type of advice do you like to give to startups, and what type of advice are you sick of giving to startups?
Sick of giving? You mean like we're just tired of having to say the same thing because everyone just can't freaking get it into their heads? I mean, I wouldn't say I'm sick of giving. I like giving advice to startups. I didn't know anything when I started my first company. I knew so little in hindsight, but what we did know was we were building a product for a customer, and we were focused on that, and that's why it worked out. But I like to give advice around stuff that they probably haven't had any experience with. All the jargon that we've mentioned on this stage, for example, like you're not supposed to understand a seed or a Series A or an angel deal, and sometimes you can learn a lot of this online. You can read like Jason Mendelson's book on term sheets, but so I like to give advice about stuff that they would not have come into contact with. In general, I like to push them to just build a product that somebody wants to buy and focus on that, and don't get caught up in all the other like venture industry stuff that seems to be, you know, sometimes takes more people's attention than it should.
What about the rest of you guys?
Look, raising money is hard. And you're not going to get a yes in the first meeting almost, right? Like that's, especially here in this area. We like to date for a while before we decide whether we want to commit. And so I like seeing entrepreneurs who get in companies who they're going to get advice and get some feedback in the meeting, and they come back and they've addressed it, and we start going on to the next thing. So that active listening and persistence, like if you send an email to, I'm sure any of us, but we get a ton of email, and we were going to miss your first one almost inevitably. But if you send that second one, right, and you say, hey, just want to follow up on this, that to me gets my attention, right? Like that means that you're clearly focused on it, you're not nervous about it. And so that's the best. I just love seeing that hunger, that that persistence to want to come back and keep doing it.
Okay.
I think Adrian just invited everybody here to send him 2 emails.
Yeah,
as soon
at
as
least
possible.
2. Yeah.
So I'm not sick of giving this advice, but I give it a lot, especially in the culture where technology is hot right now, and there's a lot of companies making a lot of big splash out west, especially out west. Getting to a point where you are profitable and you are making money, you are selling stuff and you have expenses, and then at the end of the day you have some money, means you can reinvest in your business, and goes back to Jake's original point, which is how do you keep the most amount of equity in your company? And if you don't need venture capital because you have a profitable business, you get to keep all of it, or almost all of it, and you get to give some to your employees, and you guys get to make a lot of money without taking a bunch of investment. EBITDA is not bad. Making money is not bad.
So in a perfect world, none of these people ever need any of you. Is that what I'm hearing?
That'd be great. No.
Yeah, in an actual perfect world, yes. Now in reality, it doesn't quite work that way, because if you do come up with a business model that works, a lot of time it does make sense to take on some capital to invest in that model and accelerate it ahead of profitability. That was the piece that I didn't understand when I was going through college, was the idea of investing and growing a business that's not profitable because you're investing in the growth. You can enter 15 new markets. Uber hasn't made a profit because they're entering new markets very quickly. They're burning $1 billion a year, but no one would say that's an incredible business, probably the best business that's been built in the last 5 years. And they're smart to have raised a lot of money to accelerate into those markets before other people can get into those markets. But that's generally the exception to the rule. I would say that you need to raise that much capital to grow that
I would
fast.
also say if you take away the growth stuff that you're talking about, the base business is probably a good business and probably would kick off a bunch of cash flow.
They could be profitable today.
Supporting these growth initiatives with growth capital, absolutely the right thing to do, and you can find it cheaper than venture capital money, right? If you have a really solid base business, you can borrow debt from a bank at a heck of a lot lower returns than we need, and you can fund those growth with other ways.
Well, speaking of building companies, you guys have been working for the last few weeks with your teams for the startup, and we're going to look forward to seeing how well you've done. I think next week. This class is also about, some people are like, why do you do this startup thing in this class? I don't get it. Well, because hopefully you guys are going to get through the course of this competition to get this front row seat and see the mistakes and the successes that young companies have directly under the hands of mentors like these guys that clearly have a lot of expertise. Very quickly today, though, we wanted to do a little bit of a where are they now? So I would like to welcome to the stage one of the founders from Ballot, who was our finalist last year. Please give him a round of applause. Roll video.
Every year, the average senator signs over 5,000 bills. Almost none of those bills have any input from everyday citizens. That's a problem. Ballot is a mobile platform that allows everyday citizens to have a voice in their communities and to really figure out what matters to them and let their representatives know how they feel.
So we came together to start Ballot at Startup Weekend. We all listened to Mohammed's pitch about using technology to redefine how we interact with politics, and thought it was super relevant, definitely something that should happen. And then after the weekend, we presented, got extremely positive feedback, lots of people interested in our idea, and so we came together and said, let's try and build this. This could be awesome.
I think that what makes this problem really important is that it's such like a disempowering feeling to believe that you can actually make a difference in politics. I think that's something that I have dealt with myself, and so I think it's really meaningful to work on a platform that helps to put the power of implementing policy back in the hands of the people who are affected by these policies.
So originally we had the assumption that everyone really cared about politics, and after we did some customer discovery, we found that people don't really care about politics. They care about specific interests that matter to them or affect them, like on a day-to-day basis. So essentially what we tried to go for is, instead of having, a dashboard that would give them all different types of bills that are going through Congress, we give them a very specific curated feed of bills that are pertinent to stuff that matters to them.
After the startup, we want to launch our MVP with Ann Arbor and Detroit area interest groups and make sure that they are being heard on issues that matter to them. After that, we want to expand to general citizens to allow everyone to be heard through the political process. Lastly, by the end of the year, we want to have federal and local legislatures going through our platform to make sure that everyone is being heard at all levels of the political process.
So far, Ballot has been an incredible experience, all the way from winning first place at Startup Weekend to touring the offices of Bizdom, pitching to hundreds of people at South by Southwest, and working with mentors all the way from ZLI and Spark. All these experiences have really validated our experience with Ballot and given us the confidence that Ballot can really empower many people in politics.
Wow, is it weird to watch that video a year later?
Yeah, definitely.
Please have a seat. So you had a lot of big ambitions when you finished up last year. Would you like to tell us, is Ballot still a company today?
Yeah, Ballot is definitely still a company today. Things have gone a little differently than planned, so I guess a recap of our last year. After the startup, we went and did many other startup pitch competitions, and that was a lot of fun. We got a lot of good feedback through that, but then once we got to the summer, we decided we really wanted to buckle down and try and build this idea that we had. So during our nights and weekends, we were all spread out across the country with different internships. We put together a web prototype, launched it to a couple hundred people, many people we did not know, and got a lot of really valuable feedback. The number one takeaway was everyone was like, this is great, but we kind of want this on our phone. Like, we don't want to go to our laptop for this. So into this school year, we've been working on building a mobile app, which none of us knew how to do at the beginning of the semester. And at this point, we're starting to get really close to finally launching it on the App Store.
That's cool. And you guys have space in the East Liberty Digital Garage, do you not?
Our time there just finished up, but we did for the whole first semester. And that was a really good experience. So that is, I don't know if people know what that is, but that's a startup space down by the Tech Arb with several startups working there, and it was a good community.
And what's the most important thing you feel like you've learned in the last year plus now that you've been working on this?
Number one thing is definitely the team that you launch your startup with. We have a fantastic team, people with really diverse backgrounds, really diverse skill sets. And I think that's what's really kept us together for the entire year. We started with 4 of us, and all 4 of us are still working on it, even though Lawrence, for instance, has already graduated.
Is there one piece of advice that you were given that you didn't listen to, but now you wish you would have listened to sooner?
Ooh, let's see. Nothing comes to mind like right away. The first thing is, I guess it's just like really hard to build things. It takes a lot of time, and you really have to just stay very focused on what you're working on because there's a lot of distractions, especially when you're at school.
Cool. Okay. I'd also like to welcome one more of last year's startups. Julian, I see you in the wings there. Julian was a former participant from the company which was then called Medio, but has since rebranded itself as Nomsy. You guys have had a really incredible year too. Can you give everybody a quick recap?
Yeah, so it's really interesting and it's really cool to be up here. But we went through a lot of different pivots. We spoke with a lot of our mentors and advisors, and we went through a business accelerator called Cool House Labs out of Patowski. That was a lot of work. A lot of work, a lot of long hours. Like every single morning it was probably like 8 o'clock, and then we would stay there up until sometimes midnight. Then we had demo day with Desai, which was awesome. Spoke with a lot of VCs. And then recently, Robert Greenfield and myself, we were in the New York Times, and we also went to the White House for the I Have a Dream Summit with President Obama's My Brother's Keepers initiative. And we recently just gained revenue. So we're very
Congratulations,
positive.
that's a big boy step.
Yeah, thank you. Greatly appreciated. We were celebrating the fact that just a year ago, like we started off as Medio, and then now we're Namsi.
I know, I remember.
Yeah, I mean, I know it's kind of repetitive, but like to all of us, it's just amazing.
So you talked about a lot of pivots, and I know a little bit about your journey. Was the first pivot the hardest, or did they get easier? Or then did you start worrying that you were pivoting too much? Like, how do you calibrate that?
Yeah, so in the beginning, we were listening to a lot of people, and I think we just didn't take the advice with a grain of salt to where we really wasn't confident. And then as we went along, we started to just become more confident of what we knew from our observations. And the more that we did customer discovery, the more that we gained our confidence in what we were trying to understand, which is the problem. And by understanding the problem, we were able to provide a great solution. And we're also very excited for our product launch, which should be in March.
And when you talk about customer discovery, because that's what these guys are going to see next week, what does that mean for people that don't understand? Like, what is customer discovery? Yeah,
so a great example that I would give is that, like, if someone if you used to have like $20, right, and the person is to convince you to kind of like provide that service, in order for you to like actually give them that money, it would probably make sense that that person provide something that you want, that you would find a value of $20. So with customer discovery, it's really asking what is the pain point that you have and how can we best address that? And it's really understanding the customer, because really the customer is the one that is going to have your company sustain itself and actually exist. So customer discovery is pretty much the basis of any type of company.
Well, first of all, props to both of you guys, because you beat some pretty long odds to even be sitting here a year later and still making great progress. So that's excellent. We have a couple of minutes left. Are there any questions from anybody in class for either our venture capitalists or our entrepreneurs? Yes, ma'am.
There are some real companies that have started raising money from Kickstarter because it's smart. It's a better way to, like, I think the best way to raise money is for your customers to pay you for a product, but there's a little bit of a catch-22 there because sometimes you can't build it until you've sold it and you can't sell it until you've built it. But nice thing about Kickstarter is you can actually sell it before you built it. So over the last couple of years, real companies have started on Kickstarter, and it's great. I think some really early stage VCs, maybe that's like competitive for them. Like maybe they would have liked to put the money in instead of, but I think in general, VCs like it because they can see the product get traction. You can come to them and say, hey, I know I told you people want this, but actually we just pre-sold $300,000 worth of this stuff, so that is real validation, and now I feel more comfortable as an investor putting money into it. So overall, really good thing.
I don't know, I keep buying things that aren't going to show up till like 2019. So are there other questions?
That's a cool question.
Tertiary question. Like,
So
I'll take a shot at the answer.
It is a good question, actually.
Yeah, it is.
The whole conference I was just at was everybody saying, hey, what's the IPO market going to do to venture capital, and what's the the broader macroeconomic trends going to do? But the truth is the valuations are coming down, and I think a lot of LPs or investors are okay putting money into companies today. Maybe even more so than they were last year because prices are kind of working themselves out a little bit. So you hear both sides of it. One person will say it's better today because valuations are better and today's a day to buy when prices are low, and other people will say we're scared, we're putting our money under a mattress and see what happens this year.
Evan, I'm going to give you the last word on this.
If you look at long-term trends in this industry, the best returns come from the times where it's really, really hard to raise capital, and the worst returns come from times where everybody is feeling rich and puts all their money into a bunch of VCs that all are competing. The last couple of years have been the latter period where it's been easier to raise capital. There's a lot of people who are feeling better about their financial situation than they were in the 2007 to 2010 period. And so I think you really have to ask, is that kind of a lagging or leading indicator as to what's going on in the economy, how people are feeling about their own personal wealth, how much money is going into VC, and we're not going to know the results of that for the 7 to 10 years that it takes for a fund to actually get to the kind of exit horizon. So the story is still to be told, but I think if you go back and track interest rates alongside the return profiles, you'll see some pretty decent correlation there. So.
Okay, we're over time. Everybody have a great weekend, and we'll see you next Friday. Thank you. Thank you to our guests.
I went to Amazon and moved across the country, one end of I-90 all the way to the other end of I-90, and started off in operations at Amazon. And I spent 8 years there where about every 18 months there was something new and scary that they didn't